that's hopefully some decent ideas to you on why these companies turn to investors in order to get money to get bigger. Some of those companies might have been able to stretch it out and find some way to get where they are in 5 or 6 years, but most of them couldn't. Most of them would have just been out of business after a year or two if they hadn't gotten any money. So now they're up and running. They're all still going. Hopefully they'll all survive the pandemic. All right, so where's this money come from? Where do startups find money? I used to be a techie. In the tech world on the left, it's really simple. There are angels and there are VCs, and that's about it. And there's tens of thousands of angels. We actually don't know how many, but it's less than 100,000 in the US. There's about 800 or so venture capital funds. It fluctuates a bit as the market changes. The angels tend to organize themselves into groups. So you don't have to find, if you're an entrepreneur, you don't have to find 50,000 angels one at a time. You can find a few angel groups in your home city and pitch 40 or 50 of them at one time. And that's about it. So if you're a tech entrepreneur, you go to the angels first, you raise some money. Well, you go to your friends and family first, and then you get a prototype built, and then you go to the angels. And then a subset of the companies that pitch there will get money, and then a subset of those will get funded by the VCs. Over in the impact world, it's messy. It's complicated. This is not even the whole picture. This is just the simplified picture. And this, in fact, comes from Realize Impact's project called Investor Flow. We have 450 investors in an online network from all around the world. And this is what they reported as their structure, right? So about a third of these investors out there that we found were individuals. Some of them overlap and say, well, they're also family offices. Some of them overlap and say, well, we also run a foundation. And some of them overlap and say, well, we're also running a fund. And then there are funds that are run by families, and there's funds that are run by foundations, and there's funds that are just funds, right? So like Fledge is a fund. It's one of the ones on here. And then there's a bunch of others, where others is a whole lot of different things, including groups of investors, groups of family investors, groups of foundation investors. There are wealth advisors of all different shapes and sizes. And it just gets really messy. I didn't even include on here, we don't have any of the government institutions on here, but there's another big block, which is what we call DFIs. These are the government pools of capital that sometimes invest, not just donate, but sometimes invest into these companies. So if you're an entrepreneur, the reality is, if you're an impact entrepreneur, it's really hard to figure out which of these groups you should be talking to. Just because they're in one of these buckets doesn't mean they're smaller than the other. Over on the tech side, angels tend to write smaller checks than VCs. It's almost a truism, with a rare occasion of a really rich angel. But over on the impact investing side, some of the funds write smaller checks than the individuals. Some of the families write smaller checks than the individuals. Some of the foundations write smaller checks than the funds. Right? There is no size hierarchy of these blocks over here. There just happens to be a mess of investors of all different shapes and sizes who call themselves different styles of organizations. In terms of scale of how much money there is at least 1,000 times difference between the tech investing world and the impact investing world in terms of amount of capital. So for every dollar that's invested in impact, there's $1,000 invested in the tech side. What this looks like is when I'm seeing deal flow here in Seattle for a tech startup, tech for good, or just straight up tech company, they're almost always raising $500,000, $600,000, $700,000, $800,000 as their first capital outside friends and family. And over on the impact side, a lot of them dream of doing that, but very few actually can do that. There just isn't enough money. They're tending to raise, $50,000, $100,000, maybe $200,000, which is not 1 in 1,000, because then there's the next stage of money. Then the VCs come along and write $10 million checks to the tech startups. And the funds come along on the impact side and write $500,000 checks to the impact companies. Occasionally $1 million, but really rarely $1 million. Usually it's still down in the hundreds of thousands of dollars range. And overall, we know the tech numbers really well because they're tracked really well, and it's billions of dollars. It's tens of billions of dollars per year. And on the impact side, it's maybe $1 billion. Maybe it's probably in the hundreds of millions in the early stage startups. overall, if you're an entrepreneur, this is the actual slide I use to teach the realities of funding, the opposite of the realities of startups. On the realities of funding, here are the stages of where startups go. And the stages don't have well-defined, agreed upon names. But the names I like to use and others like to use would be seed, as in the very, very, very early beginnings of the idea. Startup, as in you have customers. And then once you know what you're doing, you know that, not necessarily know what you're doing. Now that you know there are some customers that care, that puts you in the growth stage. When you have a lot of customers and you just can't meet demand, that's a rapid growth phase. And then exit is cashing out the investors. So this would be the tech slide. Depending on what stage you're in, that sets on what type of money you can go raise and where you can raise it from. And so it goes from self to friends and family, through crowdfunding, which is something that showed up in the last 15 years or so, to bank loans and mezzanine debt, and then the public markets. And each of these stages comes with a rough idea of how much money you can raise. So seed is in the hundreds of thousands, startup is in the hundreds of thousands to low millions, early growth is in the millions, rapid growth is in the tens of millions, unless you're WeWork, in which case you can add a zero to all these. In the impact world, again, it gets a little messier. There are a couple more options in here, including single family offices and multifamily offices, and smaller funds and whatnot. And then foundations show up and governments show up, and it gets messier.